Welcome back, guys. Today we are talking about why most people lose money in DeFi. And you do not want to be one of those people. I'm going to be talking about some of the lessons learned here from me learning it the hard way and then working with hundreds of clients over the past couple of years to help them generate consistent yield. And these are some of the most um, easy ways that people end up getting misled and losing money in DeFi. So let's jump into it straight away. Number one is never invest before understanding where the yield comes from. Okay. Very importantly, in DeFi, we operate with a number of different protocols, and those protocols often have different underlying mechanisms for where that yield actually comes from. Normally, when you're providing liquidity on Uniswap, for example, you are earning a share of the tokens in the underlying assets that are in the liquidity pool, i.e., if you're providing liquidity to something like WETH USDC, you're going to be earning both Ethereum and USDC under the hood in that specific pool for providing liquidity in there. But other protocols work a little bit different. Sometimes you're earning the underlying protocol token, and sometimes you're earning yield from a yield bearing stablecoin or a yield bearing asset that ultimately comes from something happening with lenders and borrowers under the hood. So, doing the research and understanding where the yield actually comes from is so important because it means that you're not going to get misled or misunderstand what's actually happening and the mechanics of why you're being rewarded for providing liquidity in the first place. It's super important to fundamentally know where that yield is coming from so that you understand why you are earning for providing the service of liquidity. Okay, I've already touched on point number two here very, very briefly, but if the rewards are paid in the same token, you can expect some sell pressure. So I think Aerodrome Finance is a very good example of this. And I'm going to bring up the Aerodrome chart just to illustrate this point, because with the Aerodrome DEX, you are technically yield farming. Okay, that means even if I'm providing liquidity to something like WETH USDC on Aerodrome, I'm actually not earning ETH and USDC under the hood. I'm earning the Aero token itself. And the Aero token itself is obviously a volatile asset. If we think about the price action here, let's say from April through to this period in August, this is very positive price action. In fact, if we measure from the lows to the highs here, you're talking about a 389% gain in the price of the Aero token. What does that mean for you as a liquidity provider? Well, obviously, if you're earning the Aero token from providing liquidity into a specific pool, then you benefit from actually holding onto that token for longer periods of time if the token price is accruing value in US dollar terms. Basically, it means that if you're earning a whole bunch of Aero from a pool at 31 cents and the price goes up here to 60 cents or beyond, you've effectively doubled the amount of dollar value you've earned from that pool simply from holding that Aero and not harvesting it back into USDC or a different asset. Okay. However, the opposite is true on the other side of the equation, because obviously, if the token price reaches a local high and it starts diminishing in value in US dollar terms, then you can see how we went from $1.48 down to 48 cents here. That means that you need to be selling the underlying asset more aggressively to lock in that yield in US dollar terms. Because if you're earning a whole bunch of Aero at $1.49, there's no point in holding on to that as price is going towards $1 and then 80 cents, et cetera, because you're diminishing the value of the yield that you've earned from providing liquidity in that specific pool. And so point number two here is understanding that that is the reward mechanism for that particular DEX, and then obviously expecting some sell pressure in particularly during times of price action moving to the downside, and then just continuous sell pressure regardless, because some people don't want to play this game of holding the token for the medium to long term. They're simply there to provide liquidity, earn yield, and get out again. Okay. Point number three is chasing yield. This is a big mistake that we see in a lot of the newcomers to the space, because they end up seeing huge numbers. They end up seeing a whole lot of stuff happening with very large lucrative yields, 300, 400, 500% on meme coins, and they go and end up chasing those yields because of the fact that they just look so lucrative in the first place. This is a big mistake because, yes, chasing high yield can look rewarding on the surface, but ultimately, if you're providing liquidity to assets that ultimately do not have any fundamental basis and do not have the potential for long-term staying power, then you're fighting a losing battle from the outset. So that is something you need to be aware of. That is something you need to understand the underlying mechanisms around and make sure that you are ultimately not falling prey to chasing super high lucrative yields just like those 400, 500, 600%, because they will not last forever. And the final lesson, lesson number 4 here, is starting with protocols that have survived more than one cycle. Okay. I've seen this from personal experience. I've seen it from other people, seeing different protocols on Twitter and X and running to put their whole portfolio in there that are much newer. And I've learned it the hard way as well. Going into new protocols where ultimately they are not battle tested, they haven't been around for more than one cycle, they've only been around for a few weeks, if not a few months, and you need to be aware of the risks involved there. And I always try to highlight those risks, but ultimately using caution and proceeding with caution when using newer protocols, scaling into them and scaling up size accordingly. We know the likes of Uniswap and Aave and other larger dexes, even on Solana, like Radium, have been around for multiple years and multiple cycles. They have a proven track record. Their smart contracts are super locked down, they are intact, and you have the ability to have trust in those protocols because they have longer staying power. They've been around for more than one market cycle. Oftentimes, when you see yields that are too good to be true, or protocols that are newer, they're incentivizing a lot of liquidity to get into the protocol. It can seem lucrative, and I've been there as well. It can seem lucrative to put your whole portfolio into something that is paying 100, 200, 220% APY. But ultimately, if the yield seems too high to be sustainable, it should be a bit of a red flag. You want to think about using a small portion of your portfolio to test it and scale it up slowly over time until that protocol itself has a longer proven track record, more TVL, more liquidity, more users, because ultimately that is the bedrock of DeFi. It is having consistently growing TVL, it's having a consistent base of growing users and people actually using and understanding the protocol. And so starting with those protocols that have longer staying power, that have been around more than one cycle, is very, very important. So take from this video what you will, guys. We want to make sure everyone is earning consistent yield in a safe manner. And so take these lessons that I've learned the hard way, that others who have gone before you have learned the hard way, and ensure that you ultimately do not make those same mistakes and proceed with caution.